Obama? Who? I'm only kidding. He's the guy that's going to make everything right.
We must see the election of President Obama as the opportunity to lay the foundations for a much more sustainable global financial architecture. One that doesn't impede risk on the one hand, but one that does not allow the sort of excesses which have dragged us all down on the other.
I think there's a level of optimism and hope as a result of the election of President Obama, but I actually think it's still a case of wait and see.
I think it's just given people a sense of hope and potential opportunity. Now, whether opportunity will be realised is still to be seen. But
one of the key issues that I see with the global financial crisis is that we've got a global financial market, but we've got no global rules governing it.
There are incredible opportunities going forward for us, I think, in terms of repositioning institutional investors across the world. International pension funds and superannuation funds can work together collectively to see how we can better protect our members' retirement incomes in light of this crisis.
We need to assess as investors the extent to which the markets have perhaps overreacted. When do we re-enter?
I think China offers a difference which we haven't seen before, which can only be good if the US is setting the standard, and the standard is a bad one.
If you've got a 20-year plus time frame, then I think that investing in areas like China and India, which are clearly growth areas, will be a good thing to do.
I'm pretty confident about China over the short term and over the medium term and the long term. Can it save the rest of the world? Well, the answer to that is no. China is just one country. It's still going to be a very hard slog for the US. That said, a stronger China will help the rest of the world, and it will certainly help Australia.
Well, I think every country really has to decide for itself what its stimulus packages are going to be. Whilst I understand the principle that we need people to spend money, it still concerns me that what we're still saying to people, we know that spend got us into this problem. But to get us out of this problem, we're going spend. So we're not changing behaviour, and what we really need to do is change behaviour.
Really not much they can do. Just hope you live long enough for it all to recuperate and start picking up.
This is going to be a long and drawn out global recession. There is no quick fix, and there's going to be some pain. Now, if I look at the US consumer, they've spent here as a nation, and they've manufactured this much, and they've borrowed the difference. That's going to take some time to unwind, and that's going to have an impact on the emerging market economies, in particular China.
We are very fortunate indeed to have two excellent speakers today, one of whom I think will challenge your thinking on the scope and the nature of this crisis, and the other will talk about the consequences of that and introduce you to an intriguing philosophy on the business of investing. Rob Zink is Director Portfolio Strategy with Bridgewater Associates. He works with research and marketing to assist institutional investors in developing investment strategies that meet their objectives. Before joining Bridgewater in '94, Rob was with Goldman Sachs from 1985 to 1993 and Salomon Brothers from 77 through to 85. I was debating, Rob, whether to read out the years you've put here. You received a BA from Brown University and you've... I should read it out?
Don't go there.
No, never mind. And he's also got an MBA from Harvard Business School. No, we won't read the year there either. You're only as young as you feel.
Thank you, yes, exactly.
Don Ezra is Global Director Investment Strategy with Russell Investments. With his international experience and expert insight on governance and financial strategy issues, Don has the responsibility of coordinating the research leading to strategic advice given to Russell's institutional clients worldwide. In his long career as a consultant, he has practiced and been published around the world, and he's won many major awards. As he approaches what he delightfully calls his decumulation phase of his own life, he says he uses the D word but not the R word, retirement. So it's like Kevin Rudd's problem with D and R, only they're different words. So he's turned to thinking about investment and longevity protection strategies for individuals who are no longer young, except perhaps young at heart. And all this thinking, some of which he'll share with us today, has led him to co-author a book called The Retirement Plan Solution, The Reinvention of Defined Contribution, to be published in June. So look out for that. So Rob, I might ask you to take the podium and give your presentation.
Here we are on the first day of a conference. Here we are caught up in optimism and enthusiasm, and yet the message I'm about to deliver is one that I think is a little more challenging and a little more concerning in terms of where we really stand in this global economic crisis. So I apologize up front, but hopefully you'll find the perspective important to think about and important to recognize the potential consequences of the environment that we're in. Let me start at a big picture level, and first and foremost, where we are is that we've had a multi-decade accumulation of debt to the point that a debt bubble has developed, and that bubble has finally burst. As a consequence, we are in the midst of a global depression, using the word depression very specifically rather than most people's acknowledgement of a recession. And that as a consequence, being in the midst of a depression, from an investment perspective, one needs to think about in a very careful way how they go about investing and what this potentially still means in terms of wealth destruction. Let me spend a few minutes in terms of explaining what I mean by being in a depression relative to recession. Because as I travel the globe, I think most people basically think a depression is basically just a more severe recession. You know, same disease, same medicine, just stronger doses. When in reality, these are very, very, very different economic diseases. A recession, which we've all experienced a number of times during our lives, is an economic contraction that is managed and deliberately brought about by tightening of monetary policy. The central bank steps in, usually in response to overheating and inflationary pressures building, raises interest rates, which has the effect of making credit more expensive, has the effect of causing asset prices to decline, and those two in combination lead to a slowdown in the economy. And if, in fact, the central bank steps on the brake a little bit too hard, we trigger into, some periods of negative growth, which is generally described as a recession. But just as this economic contraction was brought about deliberately by a tightening of monetary policy, the resolution to the economic contraction comes through a typical monetary policy easing. And the easing has the effect of, one, obviously lowering interest rates. And the lowering of interest rates re-stimulates the economy really from three different perspectives. First, it makes debt cheaper. You get debt relief. Secondly, it makes goods that we buy on credit cheaper. Goods are on sale, so it encourages spending and re-stimulates spending. And lastly, it takes assets which generate future income, whether that be stocks, whether that be bonds, whether that be property, and basically because you now are operating in a lower interest rate environment, the present value of those future cash flows, the value today, increases substantially. So a typically easing of monetary policy stimulates economic conditions and causes an increase in asset prices, which then gets the economy going again. That's a normal recession, and as I said, that's the kind of experience that most of us have experienced a number of times, and it's one we're used to dealing with. A depression is a different disease. From the standpoint, rather than a managed economic contraction, a depression is basically an unmanaged economic contraction brought about not by a tightening of monetary policy, but the fact that the debt load of the economy reaches such a point where it can no longer be adequately serviced by the underlying cash flows and asset prices of the economy. Now think about the implications of that. If you have too much debt out there and you can't pay off that debt out of your normal income, what do you have to do? You have to start selling assets. And that selling assets causes prices obviously to decline. And the decline in asset prices then has a knock-on effect from the standpoint of financial institutions that carry a lot of these assets as part of their balance sheet. Those prices decline. Financial institutions become squeezed. Credit becomes severely restricted. They stop lending to businesses. Businesses, as a result, start to contract. As businesses contract, unemployment starts to rise. Cash flow of the economy starts going down further, which means more assets have to be sold, and you get this self-reinforcing downward process that reaches a point, even though the central bank lowers interest rates and generally to zero, it fails to have any impact on the economy or asset prices. And it's a depression, I will argue and show you evidence, that we are in today. It's this second set of circumstances that has such a devastating effect on wealth, which we've already all probably experienced up to this stage of the game, and that will continue on a going forward basis. Now, what's interesting is the resolution of these two, I said, different diseases, different medicines. In the first case, if you're a recession, it's just an easing of monetary policy and brings about debt relief. I can, now afford the debt that exists. The depression, on the other hand, is different from the standpoint that the resolution of a depression calls for some combination of bankruptcies and defaults, debt restructurings, and or inflation, because inflation is a way of easing the burden of debt. And so when you think about it, the depressionary problem is debts are up here, whereas the cash flows and asset prices of the economy is down here. It's not sufficient enough to meet these debt payments and leads to that spiraling effect that we talked about. Now, think about where we are today. Okay, if it's an overload of debt that occurred and brought on the problem, how much debt has been reduced up to this stage of the game? Very little. We've seen very little in terms of bankruptcies. We've been seeing very little in terms of debt restructurings. And yet, what's happened to the asset prices and cash flows of the economy? They've diminished dramatically, which means the problem today, in fact, is worse than it was in the beginning, not better. And so, the situation we're in is one we all need to think about, and as I said, has significant implications for how we think about investing. Let me spend a few minutes, I'll do it much more quickly, in terms of how did we get here in the first place, because it's by understanding how we got here that we start to get some insights as to how we can work our way out. First and foremost, this is the problem. And I will say, these charts are going to focus on the United States. Why? Because, as we know, the United States is the largest economy in the world, and secondly, the United States was the epicenter of the problem, the beginning of the problem. But as I'll show later, this is not just a U.S. problem. This is a global problem and is shared really around the world. But let's start with the debt level as it exists in the U.S. today. And you can see two major important issues off this particular chart. First and foremost, the magnitude of the debt level is greater than the U.S. has ever experienced before. Secondly, that the increase in debt, a lot of people have this view, well, it just happened over the last 4 or 5 years. This is a 30-year accumulation of debt till it finally reached a point of basically bursting. Now think about what this means. This means as the economy got more and more leverage, what is leverage? In a very simple way, it means you buy more stuff with the same amount of money. So the more I lever, the more stuff I buy, that drives up prices, both in terms of real assets like homes, as well as financial assets like stock prices and what have you, and it becomes, again, self-reinforcing. The more prices go up, the more I'm willing to lever that much more as long as I can, because that all feels good and allows me to increase wealth until it reaches a point of being too great for the underlying economy to service. Now, what led to this problem? It's been a combination of a variety of factors. First and foremost, and fairly obvious on the top chart here, interest rates since 1980 have declined on a fairly straightforward basis, which means at lower interest rates, people can take on more and more debt and still be able to service it out of the cash flows of the income level of the economy. But secondly, even though you see there were a number of cycles during the way, highs continually were lower and lows were continually lower, to the point where we are today, the Federal Reserve in the U.S. has eased 525 basis points, and yet we're not getting any response in terms of economic activity or asset price increases. Now keep in mind that the average amount of easing it's taken by the Federal Reserve to re-stimulate the economy and get asset prices to rise is 500 basis points. So normally at this stage of the game, and I'll show it later, things are well responding. And yet here we are, interest rates are at zero, the Federal Reserve has no more traditional firepower, and yet things are still deteriorating. Secondly, the reason that debt and interest rates can continue to decline over this period of time is the chart at the bottom, which is basically foreign investment into the U.S. As you all know, places like China, places like the oil exporting countries, accumulated massive amounts of reserves, call it savings, and that savings, rather than spending it on a domestic basis, had to be recycled back into the global economy. So here's this big pile of money that's sitting there looking for a place to invest. You know, somebody needed to take that money. And who was it that ended up taking that money? It was largely the U.S. consumer. And the U.S. consumer was willing to take on this money and continue to leverage up the economy for two very important reasons. First, if you look at the top chart, this is basically household net worth in the United States. Again, over this 30-year period, you saw a steady increase in household net worth. Why? Because the two pillars of wealth, your house and your retirement program / equities, prices continued to go up. And the leveraging we talked about before just kept reinforcing that. Well, the implications are if you feel wealthy, you're not concerned about savings. And so when you look at the lower chart, what happened over the same 30-year period of time is you went to a point where U.S. households back in 1980 saved about 12% of disposable income, to whereas today that number is virtually zero. There's no savings. Why? Because who cares? I'm wealthy, right? My house is going up, my stock was going up, my retirement's taken care of. I can spend all I want at this stage of the game and front-load consumption. For the first time in literally over 30 years, U.S. household net worth is both pillars, the house and the stock market, for the first time are falling, which means households no longer feel wealthy, which means they have to start savings rather than spend. And this whole implication on a going forward basis, the economy literally has to slow down and households have to sell assets to start meeting debt obligations. So where are we now? You know, there's a saying, you know, pictures tell 1,000 words. This is one of the great ones that I think tells a pretty meaningful picture. From the standpoint, there is no question here that the credit markets have basically shattered. And whereas the credit crisis started back in July '07, you know, things were bad and credit was a problem at that stage of the game. But when the Federal Reserve and Treasury decided to allow Lehman Brothers to fail, you see immediately back in September of '08 that the credit markets just totally lost confidence. Market participants no longer had the confidence that if I lend you $1, one, that'll even get the dollar back, or if I get it back, it's going to have anywhere near the economic value that I gave it to you in the first place. So people basically stopped lending to anyone other than, you know, the highest quality lender, i.e. the U.S. or anything that they were willing to guarantee. So this was an important thing. But what I want to be clear, it's not that the fact that the Treasury allowed the Lehman Brothers to fail that caused the problem. It just was the big catalyst. The problem existed, and the problem was, you know, was going to exist anyway. This has just accelerated the problem in a very significant way, as you can see. Secondly, and I think these charts are more compelling, and let me explain what we've got here. We call them the cyclical charts, and I could show you 10 pages of these charts. I just happened to take two charts on the top, and I know you can't see it in detail, but I think the message is pretty clear that two charts on the top really look at economic conditions, and the two charts at the bottom look at asset prices, stocks, and house prices. And what we've done here is we basically, the time zero, that black line, really is the time in a normal cycle when the central bank, the Federal Reserve, starts to ease, try to stimulate the economy. And then the black line is the average of all previous cycles in terms of how that particular factor responded. And then we drew ranges around it. And what you can see very clearly, whether it's conditions at the top or asset prices at the bottom, normally this far into an easing cycle and having eased 520 basis points, conditions and markets are rebounding. And yet here it's very clear, conditions are deteriorating in a very, very significant way. This is not a normal recession that we've all experienced. This is a depressionary environment, and you know, these are the kind of things that exist, you know, 1 or 2 in 100-year types of circumstances. And that's what we're dealing with right now. Now, one question is, well, what about the stimulus package? Isn't this going to come back and save the economy and the situation? And so the only way we know how to deal with that is sort of put a pencil to paper and try to come up with some estimates of what's the deterioration in the real economy been and what's the likelihood of the impact of the stimulus package. And I won't go through all the numbers, but what you see here is, from a real economic perspective, the slowdown between the decline in consumer spending, between the decline in household or business spending, and between the decline in net foreign spending, the drag on the economy has been roughly about 8.5%. So offsetting that is government spending now. In the government package, when you analyze it and try to break it down, even though the aggregate number is bigger, in the first year is in fact, not particularly great. And when we did these numbers, it was before the actual package was released. And so our expectation was you would have something about a 2.6% stimulus back. This still leaves you in a big hole, obviously, relative to the deterioration in the economic situation. Once the numbers came out, this is worse because so much is backloaded in future years that actually in 2009, the stimulus in our estimate right now is only about 1.7%. So the fact of the matter is, yes, these things are having an effect, but the magnitude is far too little to really try to solve the situation that we're in. As a consequence, growth is going to continue to decline. And this is just one rough estimate that we put in terms of estimating future growth in the United States. And you can see our current estimate is about a minus 6% on an annualized basis. And to some extent, the economy is already operating at that kind of a level over the past quarter. And lastly, as I said, all those charts I showed you were U.S. charts. But this is not just a U.S. circumstance. And here I just want to show you very clearly from a depressionary perspective that number one, growth is falling off a cliff, both in the emerging world and the developed world, as the top chart shows. And secondly, that interest rates are approaching zero around the globe. And as interest rates approach zero, traditional monetary policy no longer exists. And central banks have to start looking for other mechanisms, quantitative easing and other things, to try to re-stimulate the economy. And the problem is, normal monetary policy they're used to, and they have a pretty good expectation as to what the result will be. And all these other things they're starting to deal with now, they simply have never really used them before in any great extent, and they have no idea as to how what the ultimate impact will be. It's like operating with a very blunt instrument. So lastly, where do we go from here? And this is, I think, the part that's a little bit sobering. And the only way we know how to look at it is basically if we believe we're in a depression and that these depressions are 1 or 2 in 100-year types of things, let's look at what's happened in past depressions relative to what's happened so far to date. And we're using here the U.S. depression. Why? Because it was global in nature. Whereas Japan in the 90s wasn't particularly global. It was a one-off Japanese type of circumstances. But believe me, when you do the same thing as it relates to Japan, the pictures don't look particularly much better. But what you can see is that, again, that time zero is the time, that's sort of the peak in the stock market before the sell-off that has been occurring. And then we go 15 years before and 15 years after to get you a sense as to how things have played out. And what you can see is that, number one, that the U.S. equity market fell in terms of return, roughly about 85% over a 3-year period. And yet to date, where are we? We're down somewhere, pick your number, 40 to 50%, which means essentially you're halfway through the problem at this stage of the game. If you feel the conditions are similar to what did transpire in the case of the Great Depression. Now, I will say one of the things that's, in terms of understanding depressions is a problem, as you all know, is the sample size is small. There have been very few in the developed world over this past century. There's only been 3, the U.S., Japan in the 90s, and Germany back in the 20s with the Weimar Republic. And so it's hard to say, gee, any one of these define what's really going to happen here. But on the other hand, if you recognize we're in one of these types of conditions, that the possibility exists for significantly further wealth destruction from here. Just to make life a little more complicated, we just hone in on this decline in 83% over the 3-year period. And what you can see is during this period of time, during this tremendous period of wealth destruction, there were actually 6 different rallies in the stock market. The smallest 14%, the greatest 49%. In other words, there were lots of periods where optimism stepped in and people believed, stocks are cheap. Now's the time to buy before the underlying conditions were ever resolved. And as a consequence, a lot of the wealth destruction that occurred back in the Great Depression weren't necessarily that people had the assets in the beginning, but they bought too early and ended up suffering severe losses. So it makes life particularly challenging. I mean, picture sitting there while the stock market's rallying 49% and saying, why am I not in stocks? Lastly, the idea is, well, I'm not 100% in stocks, I'm in a balanced type fund or what have you, and here we just took sort of the traditional asset allocation here in Australia and put it again, how it's declined relative to what happened in the Great Depression. And again, you can see, even as we all know, there's been a substantial amount of wealth destruction, and that, again, you're potentially halfway through the problem from here. So in summary, what does this really tell us? Number one, we are in the midst of a global depression, not a recession. It's not a typical cycle that we've all experienced before. Secondly, even though growth expectations are small at this stage of the game, growth is still likely to disappoint. As a consequence, equities are not cheap if you paint this with a depression brush rather than a typical recession brush. As a consequence, traditional asset allocation remains vulnerable, as I just illustrated. And lastly, and we can explore this later, in this kind of environment, the objective shouldn't be trying to make money. The environment should just be trying to preserve capital. Thank you.
Well, I wish I was a practicing economist. I'm not, but if I were, I'd be awfully inclined to snap my fingers and say, we are going to come out of this. We all agree on that. We just don't know when. So assume we're out of it, and let's look back and say, this gives us an opportunity to rethink the investment model for retirement. So let's rethink it. And now I've got away from all the depression stuff. So as I rethink the model and say, what are the lessons we've learned? I want to think separately about two phases. The accumulation phase, when we're building up wealth, and the decumulation phase. Just as we accelerate and we decelerate, we accumulate and we decumulate. And so I hope you'll take this word decumulation home with you and use it at the next dinner party you have, because it's nice to take a new piece of jargon home. Now, I refer to something here called the 10-30-60 rule, and you won't have a clue what it is, so let me tell you what it is. If you build a reasonably standard model of accumulation and decumulation, people start saving in their mid-20s, keep accumulating till 60, 65, then start drawing down income as opposed to a lump sum, because ultimately you need income when you don't have income. However you invest the lump sum, you need to withdraw income. You start decumulating, and you live till, let's say 90. Why 90? Because it turns out that with longevity the way it is, a couple aged 60 or 65 has about a 50-50 chance that one of them will live past age 90. So if you said, when will the second death occur? The odds are 50-50 that it'll occur before 90 or after 90. So 90 is a middle-of-the-road number. So project accumulation, project decumulation. Every dollar that you withdraw in the decumulation stage consists, in very, very, very round numbers, of about 10 cents you originally saved, about 30 cents of investment return that you got during the accumulation phase, and about 60 cents of investment return that you get in the decumulation phase. So when you take your lump sum, you've only really got 40 cents out of the dollar. So that lump sum you can multiply by 2.5 in very, very round numbers before you actually exhaust everything with the investment returns. And we spend an awful long time saying, let's make sure that 10 cents goes in. And we spend an awful lot of time saying, let's make sure we have a sensible investment program to generate the 30 cents. And then we say, let's give everyone a lump sum and we'll forget the 60 cents. So I just want to emphasize how important that 60-cent number is. And what I want to do from that is just see how we can improve the model in each of the two phases. So let's start with accumulation. Your scope for improvement is an awful lot less than we have in the States. Why? Because you got something right from the start. The standard American defined contribution model was to have a default option that said you're in money market or cash or something like that, which is an awful way to accumulate money over a lifetime. because, I mean, it's not going to do much for you. Even with the high cash yields you've had in Australia, this really isn't going to accumulate to an awful lot. It's a terrible waste over a 30, 40 year period. So you've had what I think of as a growth default mode. You may call it balanced, but when it's 70% in growth assets and 30% in defensive, to me that's growth. And by and large, that has served you an awful lot better than the money market model has served the state. So you got things right from the start. We got it completely wrong. However, when you learn lessons, when you're way behind, sometimes you can jump over the advanced country and learn something new. And what America has done in the last couple of years, and it's been as recent as that, it's just been the last couple of years, I think we've leapt ahead with what I call target date investing, what everyone calls target date investing. Let me explain roughly what this does and why it is actually a step ahead of a balanced 70-30 throughout. The essence is to say, you know, over the entire period of accumulation, your risk exposure is the same as it is with, let's say, 70-30. However, it's more sensibly spread over time. My kids can afford to take more risk than me. This is the way I explained it to them. I'm 64, they straddle either side of 30. And I told them, so let's suppose you had lost all the money you had ever saved. You know what? The next 30 years' worth hasn't been affected by it at all. And so if you had been 100% in equities and had a return of minus 100%, you would have zero assets now, but it would make, what, a 2-3% difference in your spendable income after age 65? That's all, because the rest has not yet been touched. Whereas with me, I'm 64. If I've lost 20% or 40%, I don't have the opportunity to make more savings over much time before I want to start decumulating too. So essentially what you're doing is you're taking the same aggregate risk over a lifetime, but just allocating it better and having much more of it up front and much less of it at the end. So instead of a constant 70% exposure, you might start off at 90 to 100, and then very gradually over the last 15, 20 years, maybe 15 years, you start declining, and then towards the end you decline much faster, and at retirement you might have something like a 40% equity exposure. The thing is that even this does not necessarily, even though it's more sensible than a constant exposure, it does not necessarily spare you from risk. Risk has a friend called pain, and we all experienced pain last year. And in the States, people who were planning to retire in 2010 and were right on the bottom end of the glide path, 40% equity exposure or thereabouts, they still lost 24% last year. Now, if they'd been 100% in global equities, they'd have lost 43%. And as I can assure people who say, you know, losing 24% is still not saying a lot because that really hurts, I can tell you that for someone who lost an awful lot more than 24%, going back and saying, please, could I just write it down 24%? I'd be awfully grateful. Feels a lot better. So there's no escape from risk. If you want reward, you have to face risk. If you want risk's friend gain to come along, you have to expose yourself to risk's friend pain. Nonetheless, there is a difference. In decumulation, there is a tremendous amount that is of improvement that's possible. And the main thing is not to give everyone a lump sum and say, here, you're on your own, there, you know what to do, right? Go spend it, pay off your mortgage, buy an RV, travel, and then you've got a little amount left to spend on your sunset years. The first thing to do, particularly for you in Australia, is to take that qualified income stream instead of taking a lump sum. You get a tax break. The investment return on that amount is not taxed at 15%. It's a no-brainer to take that instead of taking a lump sum, investing it somewhere, and paying your tax on it. And here's a point that not many people realize. Because, on average, you need to plan to save till at least 90, if you are trying to make an inadequate lump sum last and give you spending all the way through to age 90, one way to make it happen is to buy an annuity. Nobody likes buying an annuity. My recollection is something like 5% of lump sums end up buying annuities, much the same in the States and so on. Nobody likes them for a whole bunch of reasons. But here's the key. it costs you about as much to buy an annuity as it does to decumulate to age 90. Why? Because the insurance company doesn't care whether you go at 80 or 100, because as long as 90 is the average, the early death subsidizes the later one. So it costs about as much as decumulation to age 90. For those who don't have enough to do that, they have to turn the spending dial down from the desirable amount of spending, because they need to put money aside just in case they live beyond age 90. And so for the non-affluent, it's going to turn out that longevity protection, the need to save in case you live beyond age 90, is a more serious challenge to spending than what kind of investment policy did we have and what happened to our investments. We don't realize quite how much longevity protection costs. So let me sum up with some questions and answers that we were discussing before the session. Were funds allocations all wrong, like 70-30 on average? Was that all wrong? Answer, no, not in the aggregate. An aggregate 70-30 may be very sensible in the long term, but it was just poorly spread between the young and those who were young at heart. The young should have had more than 70% in equities, the young at heart should have had less. And so the aggregate might not have been different, but the way you allocate risk and the way you allocate returns would have been quite different. Should we have been, in the aggregate, more conservative in our defined contribution programs? No, same answer. That it's okay in the aggregate, just badly spread over an individual's lifetime. Should we now hunker down in cash? No. As I said, risk has two friends. I prefer now to call them gain and pain, and we need the opportunity for risk's friend gain to come along. You turn your back on pain, you will also turn your back on gain. When it is exactly that we come out of the recession, the depression, whatever we're in, I don't know, but in the long, it's not going to last 40 years. In the long term, we need to have that gain. A money market system where all we're in cash is an inadequate planning system for retirement. And any other system-wide changes to be made? Yes, I think two phases of education. One is on that 10-30-60, which people just do not realize how important it is not only to get the money in, but in addition to keep it invested through the decumulation phase, and just education about the importance of decumulation. So that's a very quick run-through of a planning system for accumulation and decumulation. And if you have questions, I'll be glad to expand on that, but I'd rather open it up to you. Thank you.
I can see those microphones around. If you have a question, just let the folks know that you do. And in the meanwhile, I might kick this off. I was going to ask you, Rob, whether there's any possible chance that you might be wrong, but now that I've seen on your PowerPoint slides, I doubt that you'll allow me that. Can Australia avoid a depression, given that we went into this crisis much healthier than the rest of the developed world?
Yeah, it's an interesting question. The way I would sort of deal with that is, again, if you look at, define depression as I did, which is a, economic environment, much more so than an outcome specifically. Australia certainly has some advantages, but it's certainly not immune either. I mean, number one, Australia is dependent upon foreign capital to fund its current account deficit, so they're operating in the capital markets and depending on free flow of capital. Secondly, obviously, Australia, exports largely to Southeast Asia, which is good because Southeast Asia is not suffering as badly as everywhere else, but it's suffering. I mean, as you all know, China's growth is down from 12% to right now something in the vicinity of 6.5%, and I think could clearly go a lot lower. It may not go into negative growth, but a decline of that magnitude, it will continue to have a severe effect on Australia. So, I mean, Australia may survive better than others, but only because, it's sort of the, I've characterized something like the ugly contest. I mean, everybody's ugly, just, who's the worst. And
so you're saying we're uglier or we're less ugly?
You're less ugly.
Okay.
We the ugly Americans, are truly ugly.
All right, Don, let's assume even that we're potentially in a depressionary environment. Then what are the implications for investment?
Awful, in a word. I think one of the things about the uncertainty of how long a depression lasts and what happens, and some of Rob's slides were really scary. Fortunately, as he was saying, it's not a large sample, so it may not work out quite like that. But if we end up saying that is a reasonably likely scenario, enough that we need to plan against what we do there, and if I'm going to make stuff up as I go along here. If one of the other potential ways out of this is we do start, as Fiona said in the video, spend, spend, spend. We do start that again, and there's all this stimulus been put in there, and maybe we get into an inflationary environment. If we end up with, let's say, those two possibilities, what are the implications for structuring a portfolio? Well, I think the normal principles still apply. You still want to save, you still want to invest and so on, but how you invest no longer has the same confidence in the numbers that we would use. When risk is that great, when risk exposure is that great, numbers become meaningless. Because if we don't know whether the volatility is going to be 10%, 20%, 30, 40, 50, 60, 70%, let's not use numbers at all. They're just pointless. You still have to have a decision process. And I think you've got either of two decision processes. One is to say, I don't believe any numbers for the long term. All I can look at is the short term. I'm going to look at the long term as a series of short terms, and I'm just going to look at the first short term, and what am I going to do in the first short term? And you need a kind of decision rule that is something other than numerical optimization and all the good stuff that the mathematicians among us wave our arms about. You need to say something like this. It's almost a kind of regret minimization. To say, if we have a depression where everything goes down and we have deflation and all that stuff happening, what does 70-30 do for me? What does 60-40? What does 30-70? What does pure cash do for me? And try and see in the short term what that does, and then say, but we could have an inflationary scenario. So what does 70-30 do? What does 60-40? What does cash, etc. do? And then say, which allocation gives me the best of the bad outcomes? And you end up, in a sense, minimizing regret. You take the best of the worst case scenarios. It's not a numerical way of doing it, but there is at least a rationale that says, if things really go bad, this is the least bad they can go, and it's the best I can do for planning purposes. So you need some kind of decision process, and usually minimizing regret is what you come up with. It's not numerical at all, it's pure instinct.
And is that what you'd recommend at this point in time, or are you just saying that in response to Rob's analysis?
I'm saying that in response to Rob's analysis because I don't know how long it'll last. I say I'm not a practicing economist. I'm not qualified to talk about things like that. My gut feel as an investor, as an informed, as an interested and intelligent investor who is not informed about these things, my gut feel says that we will somehow come out of it. I don't know when. I don't know when animal spirits, the animal spirits in us that Keynes talked about, will start to be revived, and we will start, if not to spend, at least to spend. I don't know when that happens, and my gut feeling is that while we could be in the bad phase of the depression and keep going, my hope, and maybe it's just that I'm an optimist, is that in a year or two we're out of it, and so I look at this as a horrible, horrible, horrible dream that destroyed an awful lot of my wealth forever and ever, but, you know, there is an upswing sometime and I can look towards that. So, but Rob's the expert.
Okay, well, so, I mean, presumably everybody in the room, Don and I included, would like to think that you're wrong, Rob. You'd like to think
I'd
that
like
you're...
to think I'm wrong, yeah, believe me.
But how risky is it to stay the course of investment as we've devised it, whether it's 70-30 or whatever? How risky is that in itself?
Well, and I think the way I would look at the problem is one, as Don sort of said, it's one of least regret. I mean, here on one hand, if you believe that we have a chance of another 40, 50, 60% decline in equities here, which if we're in a circumstance the same as the Great Depression, that's what would happen from here.
So that's horrifying, isn't it? The idea that it wasn't the people in 1929 who lost their money, it was the people months and months later who went, this is the rally, that was the bottom. I think I heard somebody ring a bell, that must be the bottom. In I plunge. And we saw that in the video before we started, wasn't it? We just have to decide when to get back in.
Right, and if you look at what happened in the Great Depression and go back to that chart, what you can see is it's not that things rallied all of a sudden dramatically, and therefore, if I don't time it perfectly, I've missed one of the world's great opportunities. That things obviously did improve, but relatively slowly over time. So what's your trade-off? Your trade-off is, gee, do I potentially want to lose another 50, 60% of my wealth and continue on the current path with a belief this is just a recession and going to be resolved? Or do I at least want to recognize that that's a possibility and, more or less, lack of a better term, sit on the sidelines for a little bit until I get much clearer definition. And yes, maybe I'll miss the bottom and I'll miss the early part of a rally, but I won't be exposing myself to the kind of wealth destruction which at this stage of the game, layered on top of what's already transpired, would be extremely devastating.
And just quickly, from the client perspective, we hear over and over again that more and more Australians, still a statistically small number, are moving to cash because they are so fearful. Does that make sense? Is that a sensible strategy in these circumstances?
Yeah, that's an interesting question, because you say, okay, I want to think about preserving capital, not trying to make money, and so what is a wealth preservation portfolio rather than a wealth generation portfolio? And everybody's knee-jerk reaction, well, that's cash. Well, that's not necessarily right, because if we talk about the three examples I used as the only depressions that have existed this century, U.S. and Japan were in fact deflationary depressions where cash would have done fine. But depending upon the path that the politicians and Treasury officials take in terms of resolving the problem, you can equally run the risk of an inflationary depression, a la the Weimar Republic back in the 20s, which was devastating to wealth in and of itself.
Wheelbarrows to go and buy the newspaper, wheelbarrows full of cash.
Right, but then people they'd forget the cash, they'd take the wheelbarrow because that was worth more. In an environment like that, cash is not a storehold of wealth, because in hyperinflationary environment, holding cash destroys wealth.
So very, very briefly, what do you see as a capital preservation portfolio?
It's we've done a lot of work on it, and for those that are real gluttons for punishment, they asked me to do a workshop session tomorrow. Well, I'll go over this again in more detail and also talk about more of the implications from investing. But the work that we've looked at, it's some common. What you don't want one, you want to take less risk, and two, you don't want to be invested in assets that depend upon strong growth for appreciation, like equities, like credit spreads, like most of the commodity markets, et cetera, et cetera. You want to get out of those.
And into
some combination of nominal government bonds, inflation index government bonds, cash, and gold. Cash de-risks the portfolio. Gold and inflation index bonds serve you very well if you get into an inflationary depression. And in a deflationary depression, nominal bonds and nominal sovereign bonds, treasury bonds, and cash serve you well.
This is a big call. I mean, it's an enormous thing to be suggesting. I guess the problem with you guys at Bridgewater is you're more right than wrong a lot of the time, hey? But I mean, that's the reality. You've been saying to your clients for 12 months or so, more.
Yeah, but I mean, yes, that's right. But on the other hand, I mean, you said it earlier. I mean, there's a chance we're wrong. There's no question there's a chance we're wrong. I think the more conditions play out, the chance of that is less and less. And people are more receptive to what we have to say today, obviously, than they were a year and a half ago. But still, having said that, I mean, maybe we're wrong. Maybe this is a normal recession. But the potential downside of being wrong on that call is pretty devastating.
Right. Let's turn to your presentation then, Don. We've got about 10 minutes left here. Australians, as you acknowledged, have generally steered towards a balanced portfolio for their retirement savings. Are you proposing that funds should change that broad formula for investing clients' wealth? Or is it something more about how they educate and communicate what they're doing with an individual's investment, if you see what I mean? The macro as opposed to the micro.
I think the macro situation may not change much at all.
Right.
Because if you've got a whole bunch of young people and a whole bunch of middle-aged people and a whole bunch of older people, if the average hasn't changed, and if 70-30 is good for the average, then it will still stay that way, and it in itself will change only as the average demographics change.
So what are you suggesting that these folks change then, if they're not changing the...
Oh, I think the way in which risk and returns are allocated across their participants, that risk and return, risk and potential reward should both be much bigger for the younger participants and much smaller for the older ones. And it makes a big difference to the individual, even if it might not make that much of a difference to the super fund as a whole.
And you used that example of the annuity to last you until you're 90. We were talking earlier to Fiona Reynolds about whether or not that's something that is often thought about in the Australian context. It is. But if we took that idea more seriously, if we placed more emphasis on that, what would we and clients do differently?
Well, I think what you do differently, back a step, the reason for using that as the yardstick, it's not so much the annuity itself that lasts until 90, the annuity lasts forever. The cost is much the same as if you're self-financing to 90. If you have more than enough for that, then you've got enough to keep your spending dial where you want it for as long as you live. And so longevity protection is not an issue. Extreme case, Warren Buffett, Bill Gates, do they need to buy an annuity? No. There is no chance that they will outlive their money. But for most of us, we don't have enough to be able to buy an annuity to lock in the lifestyle we want, inflation protection. And therefore, for us, we need to set aside more and more money against the chance that we do it. And so for most of us, we will actually get more spending dial protection by buying an annuity for at least a portion of what we've got than we do today. For most of us, an immediate annuity is probably a desirable risk reduction thing, because we think in terms of risk as an investment risk thing, not as a longevity risk thing.
And we were also speaking earlier about the fact that what has happened with superannuation savings in the last little while has really reinvigorated the debate about how we do retirement savings in this country. You were giving an example earlier of what the Dutch do in terms of defined contribution schemes leading to a defined benefit. Just explain that, because that was really an interesting point.
The Dutch do things entirely differently, and they like a defined benefit because there's greater certainty of what you get. They like longevity protection. I mean, which of us doesn't like a defined benefit? Which of us doesn't like longevity protection? But the way in which they do that, without all the guarantees that have caused the system to come crashing down and be replaced by DC, they actually make it a pure DC system, in the sense that the employer, the employees, whoever's contributing, it's completely defined, and that's the sole liability. What they do then is to say, if we were to translate the amount of money into the fund into a unit benefit that could be given to everyone without having people make their individual investment and risk choices, convert it into a unit benefit with some colossal cushion. Let's say 50% of the fund is what we need to guarantee that benefit, and 50% is a cushion because things can go really wrong. And we will pay out that amount, the unit benefit, that 50% of the fund will support. And then that becomes a defined benefit, longevity protected, etc. And then depending on whether the investment return is higher or lower than we expect, we can start to give you some or none of a COLA, cost of living adjustment. So we can take your accrued benefit and start to upgrade it partially in line with salaries. We can take pensions in the course of payment and upgrade that partly in accordance with the cost of living, etc., etc. So they actually have DC going in, but DB coming out. And the reason they don't contradict each other is that there is such a huge safety margin in there. So it's a completely different way of saying there is no further liability. Nobody's guaranteeing anything other than we have collective risk sharing. Completely different way to run a system.
Hi, Lorraine Behrens from Marvin and Palmer. A couple of questions for Rob. Rob, most of the talk is about a recession rather than a depression, so I guess I'm just curious to know whether maybe there's building talk in the US that I've certainly not heard, whether Bridgewater is really out on your own in calling a depression, and if so, why your view is different to the general view. And I guess an extension to that, in terms of comparing what's happening now to what happened earlier in the US or even in Japan, some commentary is that because the government response this time has been so much quicker and so much more definitive, that the end result, regardless, will hopefully be more positive.
Okay, thanks, Lorraine. A couple of issues as it relates to, gee, are we the outlier and how come everybody differs from us? I mean, number one, I think you're seeing now more and more in the States that others are adopting the word depression rather than recession, or at a minimum, they're talking about a severe recession and maybe not really drawing a distinction. You know, the whys and wherefores of that, I think, are twofold. One is I think people don't want to, I mean, we're all optimists, right? We certainly don't want to believe we're in a depression and all that results from it. And secondly, since none of us have ever lived through one, unless we lived in Japan in the 90s, that it just isn't on our radar screen. And so I would argue most people haven't gone back and really studied depressions and understand why they're a different animal, that they're not just the same disease as a recession, just more severe, and therefore it requires a whole different set of medicines. And I think that's part of the problem, that people just never studied and never gone back and looked at it. If you study the Great Depression, which we've done, month by month, et cetera, you would be amazed at how similar what transpired back then and the responses that were transpired back then are relative to today. They eased monetary policy immediately. They had a number of government programs. They had a Reconstruction Finance Corporation, which was the identical to the TARP that exists in the U.S. today. It's not as different as I think people believe. Now, obviously there are differences. U.S. was on a gold standard. U.S. was a creditor nation, not a debtor nation back then, et cetera, et cetera. But the fact of the matter is there are far more similarities, and that the amount of money being thrown at the problem back then was too little, and the amount of money being thrown at the problem today is too little. It's all reactionary. It's not getting ahead of the game, which is what it will ultimately take, I think, to solve the problem.
One more question down here, which again is probably better than my question, which is number 2. We're all going to see, as the microphone goes down there, this is one of those yes or no questions, Rob. We're going to see our Prime Minister flying over to see your President, and our Prime Minister is going to talk about those toxic assets and whether or not the US is doing enough to resolve that. Do you have confidence in Geithner, the Treasury Secretary, and in Obama to get this right? Because there's a lot of, even Saturday Night Live, the comedy show, was hooking into Geithner the other day, I noticed. There's a lack of confidence in him, I guess, in some quarters, many quarters.
Right. I mean, and I understand some of it. I mean, but I think you also have to put it in perspective. I mean, Geithner's been in office, like about 45 days, a month and a half, and all of a sudden he's supposed to have all the grand solutions to the problem. I think that's a bit unfair.
Do you think they'll get it right in the end? Have they got the wherewithal to get it right in the end? This is the burning question for us.
Yeah, but I think we have to wait and see. I mean, the problem I see with Geithner right now, and I mentioned it earlier, is that, they talk about developing a plan to come up with a plan. They don't, what is the plan? Give me the specifics, because until you come out with specifics in terms of what they're literally doing, market participants can't make judgments. You're sort of frozen.
Very quickly, number 2.
Yeah, hi Rod, Colin Tate from Connexus Financial. You've kept it pretty kind of tidy given what you have predicted. You haven't said anything about the implications of a Great Depression. You said 85% drop in equities, but that also means 25-30% unemployment, civil unrest, global calamity. Should we just go to the pub the rest of the afternoon?
I mean, yeah, you can tell me. I'm not predicting that that's going to happen. I mean, part of the reason, there's a hesitancy, within Bridgewater even to use the term depression, because it just conjures a lot of images which are not necessarily trying, in line with what we're trying to convey, that it's a set of conditions much more than it is a specific set of outcomes. I mean, yes, in the Great Depression there was 25% unemployment. Does that mean we're going to go to 25% unemployment today? No, I don't think so. But I think you can't disregard all depressions end up with a significant wealth transfer. The wealthy basically contributing to the rest of society, whether it's an increase in taxes, whether it's the decline in wealth because they're the people that have the wealth. And that is, has significant social implications. There's no question. You hate to say it, but why did Hitler end up in power? Well, because of the depression that existed back in Germany and the social unrest that occurred as a result of that. A lot of things come under question in these kinds of environments. Now, hopefully, we're not going that direction. Hopefully, that steps we'll be taking will at least ease the degree to which a lot of things transpire. But I don't think you can sit there and ignore those kinds of possibilities.
I think the short answer is don't go to the pub, go to afternoon tea. Please thank our speakers, Don Ezra and Robert Zink.